Welcome to the second half of 2024. Right now, we've entered Q3 already. Yes, I know. Pretty insane how fast this year has gone by. Now in this video, let's go over 4 companies, 4 stocks that are worth to buy in July or put simply on your watch list. Different companies, some of them, yes, we have covered on this channel before, some new ones as well. So without further ado, let's dive right into this. Like, subscribe, hit all the buttons, do all of that. We're on our way to reach 50,000 subscribers, so I really appreciate all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And so company number 1 is called Qualys. This is the first time I'm covering this company on the channel, and I'll explain why. It's a company that provides cloud-based platform delivering information technology, security, and compliance solutions in the United States and internationally. It offers Qualys cloud apps, which include cybersecurity asset management and external attack surface management. Of course, in the age of AI and everything becoming digital, you're going to need these types of companies more and more. Over the past 3 years, the stock is up 40%. Year to date, the stock is down 27.3%. And over the last year, the stock is up 12.46%. Currently, the forward PE sits at 27.3 times. EV to sales in the next 12 months, 7.7 times. If we look at what the analysts are expecting for this fiscal year and the next 2 ones, fiscal year 2024, sales growth of 9.2% with EPS basically being flat. But then we see a reacceleration in EPS in fiscal year 2025 and 2026, while sales growth remains approximately the same. If we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, compare that to the 5-year mean, you can say that the stock right now is cheaper. Does it mean that it is undervalued? Not necessarily, but it is definitely cheaper than its 5-year mean on all metrics. And this is a company that has been buying back shares in the last couple of years, but more importantly, free cash flow per share has gone up quite a lot in the last, let's say, 8 years or so. How did they achieve all that? Well, steady revenue growth, steady free cash flow growth, same with gross profit that has been growing quite nicely throughout the years, and so did net income. If we look at return on equity, 48.28%, that's quite tremendous. Return on invested capital, 34.35%, so definitely a quality company. Qualys, quality, interesting. If we look at the current analyst price target, that sits 14.12% higher than the price we're at today. Like I said, this year, profitability-wise, we are coming down a little bit, a small little reset, but as we've seen, the market is expecting a reacceleration in the next 2 years, which you can clearly see right here. Sales, gross profit, EV to EBITDA, EBIT, all of that has grown nicely, but scrolling back down, EBIT, net income, EPS adjusted and GAAP, yes, on a year-over-year basis. For the next coming quarters, we are going to be down because the year beforehand, we have grown quite fast. So the year-over-year comparisons become a little bit tougher for the next coming quarters, but overall the business is going up quite steadily. It's not 20%, 30% year-over-year growth, no, but it's growing steadily, it's very, very profitable, returning value to shareholders for quite a long time. This is a quality business. Right now, looking at the graph, it seems like we have found a bottom-ish at $135. That's where RSI was extremely low and basically very close to being oversold. Since then, we had 3 weeks of green candles, which brought the stock back over the 20-day moving average, still far away from the 200-day one at $158. The 50-day one sits at $148. But yeah, we've come a long way from that top here at $204 back in late 2023. Up next, moving to company number 2 is a company I personally own, and you're probably tired of hearing about it, but I do still think that if it works out, it's now extremely undervalued, and that's Intel. Intel has been underperforming as one of the probably the only semiconductor that is down in the last year. Actually, I mean, it hasn't done much in the last 3 years as well. It's down 40%, and in the last 5 years, it's down 25%. Why is that? Well, because Intel is still in that turnaround story that might or might not succeed in the end. But overall, when you talk about the semiconductor industry, Intel is still a big part of it. And Intel right now is probably one of the only companies in the West that will provide some stability in the semiconductor industry, in the semiconductor supply chain. Of course, it first needs to scale up its foundry business, because I think that right now the full story for Intel is definitely based on whether or not the foundry business is going to be an extremely successful one. We know that TSMC is a very, very successful story, but TSMC is in Taiwan. That region remains a little bit on the unstable side of things, and you do not want to have 80% of your supply coming from one area. So, Intel, right now, valuation-wise, forward PE 24.4 times, EV to sales 2.9 times. Analyst estimates in the coming fiscal years, sales growth for fiscal year 2024, not much, 3%, EPS growth 4.6%, but then huge reacceleration in the next two fiscal years, 12.19% year-over-year growth in fiscal year 2025, and close to 80% growth with regards to EPS. Moving to fiscal year 2026, 9.5% growth for sales and 30.24% growth for EPS. And of course, this will change as the company will give us maybe better than expected guidance or worse than expected guidance in the coming quarters. Looking at what has happened with Intel's business over the last couple of years, it's pretty clear. It peaked in 2021, revenue peaked there. With regards to free cash flow, that peaked a little bit earlier. Since then, revenue has come down, profitability of the business has come down as well, as they basically, had to reinvest quite a lot of money in the business and change the way the business is operating, which is why you've seen return on equity go back down under zero. Return on invested capital is now just 2.18%, and ROE, return on equity, sits at 3.79%. If we look at gross profit, still in the billions of dollars, right? $22.9 billion, but still far, far away from where we were previously, back in the $40 billion. Net income as well, far, far away from where it was back in 2021, 2020. But I truly believe that they're making their way back up. If we look at some valuation metrics, yes, it's true that right now Intel, despite it being down quite a lot, valuation-wise compared to its 5-year mean, it is more expensive. Why is that? Well, we've explained that a couple of times in the past videos. It's because, the stock has gone down, but the business, especially from a profitability side, has taken such a big hit. When for a quarter or so you're unprofitable, that's usually where your valuation metrics take the biggest hit. Now, in the coming quarters, we can see suddenly that profitability comes in better than expected. And if the stock doesn't move much, then you're going to see forward PE come down, EV to EBITDA, price to sales, and all of that come down. If you look actually at price earnings to growth, sits at 0.51. Definitely on the cheap side, in my opinion. Currently, if we look at the average analyst price target, it sits close to 30% higher than the price we're at today. By the way, Intel also pays a dividend with a 1.61% dividend yield. Is that smart? Not that much, but I guess they have to give back to their long-term shareholders. Now, if you forgot what has happened last quarter and what the outlook was, it's basically now on the screen, so you can pause the screen. For the outlook, they expect revenue to come between $12.5 and $30.5 billion, gross margin non-GAAP 43.5%, and EPS non-GAAP of just 10 cents. Hopefully the numbers come in better than expected. As for the chart, we have been now in the $30 range for quite a while, so maybe that's the bottom. That's where the stock has stabilized, and then we're now waiting for the upcoming quarter, which should be at the end of July, I believe. Yeah, July 24. So hopefully by then we get some better numbers and we can start going back up. The 200-day moving average sits at $36.84, the 50-day one at $32.62. Up next, ladies and gentlemen, but especially ladies, we're talking here about ULTA Beauty. Ladies, I think there's only 5 to 9% of my viewers that are female according to YouTube. But okay, ULTA Beauty. In the last 3 years, the stock hasn't done much. It's up only 10%. In the last year, the stock is down 16.56%. And year-to-date, stock is down 21.25%. We've talked about ULTA, I believe, 2 months ago or so. The the stock hasn't really moved much, so it's yet again on that list. Valuation-wise, we're at a 14.6 times forward PE, EV to sales 1.7 times. If we look at what the analysts are expecting, EPS basically down to flat for this fiscal year, or fiscal year 2025, shall I say. Growth for sales 3.17%. Then in fiscal year 26 and 27, a small reacceleration in sales growth, 6% or so, but EPS should be growing at 10% year after year. Looking at the valuation metrics, here it is pretty clear that the stock is much cheaper than its 5-year mean on all the metrics. If you look at price earnings to growth, 1.2, in my opinion, that's quite cheap. All the rest, EV to EBITDA 10.4 compared to 14.2, price to sales 1.6 compared to 2.1, and then price to free cash flow 20.1 compared to 23.2. That's in the last 12 months. But as we've seen previously in the last 10 years, shares outstanding has come down by 25.4%. Free cash flow per share has gone up as well. So definitely when it comes to shareholder value, that value has increased throughout the years. Of course, more recently, the stock has taken a hit. But do you think that the beauty industry will disappear in the coming years? I don't think so. I think that ULTA is also an extremely strong player in that industry, strong company, no debt, massive free cash flow, buyback program. So it's still a healthy company. Yes, it has struggled a little bit in the short run. Now, right now, if we look at the average analyst price target, it sits close to 25% higher than the price we're at today. And here, if you look at the graph, like I said, since the last time we've talked about this company, the stock has not moved that much. RSI is still pretty low. The stock is still around $385 or so, under the 20-day moving average still. But you could say that this is an area where it did find a bottom for quite a long time, right? Even if we go back to June of 2022, August of 2022, October 2022, even October 2023, although it went down a little bit to 370 there. But this is an area where I feel the stock has bottomed. It is now forming a base and waiting for the next earnings report. Then, of course, we will see what happens with those numbers. But as we enter, let's say, the phase where interest rates, in my opinion, have peaked, we're now just waiting for interest rate cuts. It will definitely ease the pressure on a lot of companies, a lot of stocks, and definitely the consumer as well. Moving on to stock number 4, yes, controversial as always because it is a Chinese stock, and that's PDD Holding, Pinduoduo. Now, maybe you might turn off this video. If you do so, don't forget to hit the thumbs up button. No, but for real, Pinduoduo, you all say, well, a lot of people say that, oh, who's investing in Chinese stocks? Well, okay, year to date, it's down. But if you look at the last year performance, stock is up 85.48%. So definitely someone is buying this company, right? And rightfully so. It has a market cap of $184.6 billion. Forward PE, 10.8 times. EV to sales, 2.4 times. Not that expensive, right? I mean, if you look at what the analysts are expecting for the coming fiscal years, I know some will say, yeah, but you don't know if the accounting is correct, etc., etc. Okay, that's, I guess, the risk you are taking. But if you look here at sales growth for fiscal year 2024, 63.35%, EPS growth, 79.3%, moving to fiscal year 25-26, 25.9% growth and 19.5% sales year-over-year growth in fiscal year 25 and 2026. For EPS, you're staying between 26% growth and 20% growth. So definitely still a fast-growing company, top and bottom lines. And despite being up over 80% since last year as a stock, the business has become cheaper. If you look at all of these metrics, it is much cheaper than its 5-year mean. Of course, previously it wasn't that profitable. It wasn't profitable at all. So let's say 3 years. Even the 3 years, you are cheaper. If you look at price earnings to growth, 0.3. I mean, that is very, very cheap. It's a fast-growing company, sales and EPS-wise. Yes, okay, it's a Chinese one. And here you get maybe a better visualization of how the business has been doing in the last couple of years. Revenue growth, free cash flow growth, return on equity 46.3%, return on invested capital close to 30%. Gross profit has gone up quite a lot, net income has followed as well. So definitely a very, very good business. Now, whether or not you want to take the risk is up to you. If we look at the graph right now, we are not in a great area. It has seen two big red candles on the weekly. We might have topped here at around $160 or so. So I would say look for a rebound at the 200-day moving average, which sits closer to $124, $125. Previously, it did rebound at the 200-day moving average back in April of 2024 and March of this year. So that will be it for this month's episode. For stocks, of course, I can talk again about SoFi, about PayPal, about all of these types of companies that we keep on talking over and over again, because I do still believe that PayPal, for example, still at $60 or just under $60 is still one of the best stocks that you can choose. You know my opinion on that. I'm not going to repeat it in each and every video because I do want to put some other companies in that series. So that's about it for this video. Of course, do share your thoughts down in the comment section below. If you want me to cover a specific company that seems cheap or has been hit quite a lot more recently, let me know down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.